Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Seems like a green start. Taiwan index holding on to very strong gains of 3.27%.
So we're going to give this one shot. I'm in no hurry. You never think, oh, the midterms, I'm in a hurry. I'm in no hurry.
Oil relief impulse across asset classes. S&P was up 1%, NASDAQ was up 1.5%, 170, 180 on the Nifty. So 23,846. The sensex is up about 600 points.
So around 10 to 12,000 crores kind of asset addition every year we will be doing from here on.
While top line is good, we've always said that profits are give you more comfort.
We had received only one rating upgrade in the month of April, and the costs were already down 100 basis points.
The revenue weakness was largely factored in.
It'll be listing on the NASDAQ as early as next month. Roadshows are going to begin from the 8th of June.
The real chapter begins when ChatGPT and Claude makers head to the Wall Street.
We are very close to the day's low, actually slipped below the 23,600 mark. That was the day so far. 1 hour to go. It's Sensex weekly expiry. We're coming to you live from the close. We're coming to you live on closing bell, live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel. And as you heard, markets have come off from the day's high. It's nearly 200 points of gains being trimmed at the day's high. The Nifty was at 23,860. Now, as we speak, we're in the red, about 200 points lower. For the mid-cap index, too, we've lost about 1% from the top, though the Nifty small-cap 100 index is still going pretty strong. So that's got a gain of more than 0.5%, which is why you can see the advanced decline ratio still in favor of the gaining side. Well, sectorally, just to give you a flavor, IT, FMCG under pressure. Both those indices are down on the way up. You've got defense. That's the sector which is leading. You've got real estate doing pretty well. And some numbers are coming through, and you can see the reaction. So Imami is one. Let's get that stock up on the screen. Imami numbers just came about 10 minutes back. The stock has tanked about 4%. The company's profits are down 12% year on year. Margins are lower at 20 versus 23%. And revenues, too, are down 4%. That's the reaction on the screen for Imami. And the other one is Sandhar Tech, where profits have gone up 50%. Revenues have gone up 30%. And the margins have been maintained, and the street is rewarding that. So Sandhar Tech has moved to the day's high. It's 8% pop on Sandhar Tech. So I think it's all about, at the index level, again, once again, the 23,800 seems to be acting as a bit of a resistance.
Well, that's right, Rima. I think numerous times I've seen this 23,800. We've gone to that mark, and then we're making a bit of a meal out there. So, that's a bit of an issue. But how do you position yourself in the final out trade? Mitesh Thakur joins us to help us out with exactly that. Mitesh, what do you think? We're not falling apart, but every time we're testing that level of 23,800, the bears are coming out and giving a punch. What do you think?
Nigel, good afternoon. I think that was the view in the morning as well. I said, unless until we sustain about 23,800, this is not a market to attempt or get serious longs with that gap up, which the GIFT Nifty was indicating today, and it did happen. But as you rightly said, that's an important pivot. I think the next leg of up move will happen only if we start getting a close about 23,800, 900 band. And till then, I think it's a choppy market. It's a tedious market. It's basically doing 23,300 to about 23,800, 900 on the upside. And not much of directional bias. Having said that, I have a buy on Dixon Technologies with a stop below 11,000 for targets of 11,800. And Jubilant Foods, I think some news flow as well over there, but it's just a gap down and a negative breakdown on the charts. That's a sell with a stop at 445.5 for targets of 417.
Got that. That's the call coming in on Jubilant. In a bit, Mangalam will also join in to explain the fundamental reasons behind Jubilant Foodworks and what the street was disappointed with. But any other stocks that you'd like to highlight? When we look at the mid-cap end of the screen, it's quite active. You've got a Yes Bank, you've got an Eternal, not mid-cap, but Eternal is under pressure today on the way up. And IRB Infrastructure, JSW Cement, Angel One, Samvardhan Motherson. Many of these earnings reactions are playing out pretty well. And IRB Infrastructure we spoke about. Any other stocks you'd like to highlight?
Yeah, I think JSW Cement is definitely catching my attention. If you look at the movement from November last year onwards, on multiple occasions the stock has kind of peaked around this 130, 132 mark, but the structure has improved dramatically. The indicators are turning positive, and if it starts getting past this 132, 135 zone, and I think today high also is about 132.13, then I think the stock could give you a short to medium term uptrend. The first near-term target would be 145, but the medium to longer-term target should be in excess of 153, or in a good case scenario, even 160.
Got it. Okay. All right. Talking about the JSW Group. Thanks, Mitesh, for that. We'll keep coming back to you. So let's focus on JSW Cement then. One of the stocks that are actually reacting positively to its numbers. Those numbers look good, by the way. On the top line, there's a growth of close to around 11%. And I'm looking at, their volume number. That's come up by close to around 6.8% on a year-on-year basis. That's the total volume, with a core cement volume at around 2.4 million tons, which is a growth of close to around 12%, while the GGBS volume, that's up by close to around 5.4% or thereabouts. So the top line growth that we're seeing in double digits, more than 50% has come because of the volume growth. The remainder will be because of realizations. But the operating profit has surprised everyone. That's very, very good. That's up by close to around 50%. And if you look at the margins, this is one of the companies that's shown a good improvement on a lower base. On a sequential basis, it's higher. On a year-on-year basis as well, it's higher. And they've not only focused on operating leverage that has played out and higher realizations, the cost, have come in lower. Whether you look at the employee costs, other expenditure, power and fuel, all of them are lower on a year-on-year basis. They've also reported a big net profit, but you need to keep in mind there's a big tax write back out there. So that's why it's giving it such a big bump up. But as they've repaid some part of their debt, you have the finance cost as well that's coming down. The company is at around 24 million tons in terms of a capacity. They've gone ahead and announced another 2.5 million tons at just around 430 crore rupees. They're saying that they're going to be financing this grinding capacity by internal accruals as well as by debt. It's going to come at very, very low capex. And I'm just looking at the presentation. The net debt number as well has been updated at around 3,635 crores odds. So put everything together, that's a stock that actually corrected from 150 all the way to sub 110 rupees. Today, it's bouncing back on the back of a rather good set of numbers. Deven Choksi, the MD at DR Choksi FinServ, joins us on the show. Hi, Deven. Good afternoon. Good to see you, Ven. JSW Cement, promoter pedigree is there. They have the backing of the, of a solid promoter. But the company listed at 150 and it pulled back very quickly. Since then, a lot of brokerages have been getting quite optimistic about its prospects. What's your view at 130 rupees?
And Nigel, good afternoon. Well, on the face of the numbers, I think the realization seems to be pretty decent on a per ton basis. And that gives you the confidence that, yes, I think probably the business is coming onto the stream in a very structured manner. In the first half of the financial year, probably I think that was not the confidence emerging, and that could possibly be the result of a stock price falling. But I think in the second half, in the third quarter, and more importantly in the fourth quarter result, numbers on a per ton realization basis, I think is also little better compared to what it was in previous quarters. And the slag cement business also both, I think, has given a reasonably good amount of outlook. So I think the green portion is also now getting in, or being seen here in the performance. In my viewpoint, I think we'll have to see the sustainability of this. Otherwise, I think it looks pretty decent with the kind of expansion that they're talking about in the capacity.
Okay. Hi, Deven. Good afternoon. Let me get your views in on Honeywell Automation. But before that, let's quickly go across to Vinny because stock is on fire. Very strong numbers. And Vinny, brokerages too like the performance. There's an upgrade coming through.
Absolutely, an upgrade coming in from JM Financials for Honeywell Automation. And first, let's look at the numbers. 6% growth in terms for the quarter. They managed to see an improvement in terms of EBITDA margin. 15.6% is what the EBITDA margin stands at, and improvement in terms of profit also. Now, margins, that's the interesting part, right? Overall gross margins have improved. Then you've seen EBITDA margin improve. And that's what everyone was waiting and watching out for in terms of the margin improvement. That seems like that's working out well for the company. So that is why JM Financials upgraded the stock to a buy, target price of 44,000 rupees. They believe that Honeywell Automation is actually cheaper than its peers in terms of valuation, trading at just 34 times FY28P. So that's the lowest amongst the automation peers. Now, apart from that, for them, revenue was slightly below their expectation, but like I said, margin was the surprise that they were happy with. The company has been focusing on, maybe reducing those low margin businesses and focusing more on high margin projects, and that seems like is working out well for the company. So they said that now this seems like a story that from Q4 FY26 onwards, maybe we'll see that consistent improvement in terms of margins and better margins for Honeywell Automation, and that is why the stock is running away in trade.
Thank you very much for that. Devin, you heard what Vinny had to say. Do you want to comment?
Yeah, I think the overall the value-added segment, I think, has started possibly contributing better, though I have not seen the complete breakup of it. But on the top of it, I think from whatever the broader numbers that I've analyzed, I find that I think the revenue and the profitability is basically now coming largely from the better margin services and the products that they are providing. That's what I think one is gathering, but one would like to look into it a little bit more in detail before making any point at this point of time. Looking pretty set from the point of view of the larger capex program which is undertaken by majority of the industry, including their segment of customers in the refining as well in the power sector. So from that perspective, I think the business condition looks relatively more stable for Honeywell Auto. Looking forward to some more details from management and then probably take a firmer view on the subject.
Okay. Imami, numbers a bit disappointing. Manglam was just telling us unseasonal rains in March have impacted their summer portfolio, as a result of which sales are down 3%, volumes are down 7%. But if you look at the portfolio X of the summer portfolio, there is growth, 11% growth overall, 7% volume growth. The problem has been the summer segment, where overall sales are down nearly about 22%, which is basically your Navratna, Dermicool, Boro Plus, which includes prickly heat powder. On Imami, do you have a view? Because this seems to be a seasonal issue. It will bounce back.
I haven't seen the numbers in detail, so probably I think would reserve my views for some other time.
Okay. Protein eGov was reporting very modest numbers, but this quarter it's come back very strongly. 39% revenue growth seen, strong margin expansion also. Is this a stock under your coverage?
Not fully under coverage, the soft coverage this company is, and I think looking forward to get some more details. Always found that I think this company holds significantly large amount of potential. Yes, in the past, probably I think because of that expected the numbers, but the stock had a decent and very smart run-up. Maybe one will have to look into detail after the result has come. So I think we'll wait for some more time to get the data analyzed.
Okay, let's talk about Page Industries. That's another one where numbers came out a while back. Strong volume growth in Q4. Devyani joins us with more numbers. Devyani.
Well, it's a good quarter coming in from Page Industries. Now, headline numbers are all above Bloomberg estimates by anywhere between 6 to 11%. Now, this was driven by an 11% growth that was seen in the sales volume year on year to roughly around 5.5 crore pieces. Now, keep in mind, in an exclusive interview with CNBC-TV18 in the month of March, management had guided for double-digit volume growth going forward, and it has clearly delivered on it. Now, revenue as a result was up 14% to 1,253 crores, and direct costs this time around are up 21% with inventory build-up, and as a result, this has impacted EBITDA margins slightly, yet EBITDA has still come in at 11% to 261 crores, and PAT has come in at 9% up to 179 crores on a year-on-year perspective. All in all, a good set of numbers coming in from the company, and as a result, the stock is up in trade today.
Thank you very much for that. Crude prices are inching lower. When we started the show today at 8:30, at 9 o'clock when markets opened up, Brent crude prices were closer to 106. It was a handle of 105.8, 105.9, and now it's down to 105. So that could help markets today. And there you have Rupee also holding on to its gains. It's about 42 paise stronger today. 96.39. Yesterday, we hit record levels. There was a swap announced of $5 billion by the RBI, and that's helping the rupee hold strong today. But other than that, for the Nifty and the Sensex, it's been a day of consolidation. We've come off significantly from the day's high. Let's just get in a quick check on European markets if we are seeing significant moves. Asia had a very strong session, particularly its Kospi. I think the street is excited with all these tech IPOs coming through on Wall Street. So Kospi, which is index, Kospi and Taiwan, most indexed to the AI play, AI proxies. Kospi closed up with a gain of about 8.5%, while Taiwan was up 3.5%. Europe right now is flat-ish, but with a positive bias. Hang Seng and China both today were down. Devin, any other stocks that you liked from the earnings so far in the last 2 days?
Yeah, Rima, I think a couple of ones which have caught my attention and probably happy to find one among them is Tata Technologies. The management outlook and the commentary is also extremely strong. The mix in the revenue is also now becoming slightly better from predominantly automobile to higher share of aviation into the revenue book. I think that is also happening. The EBITDA margin is now being suggested to be better. And at the same time, the larger amount of growth is coming due to the use of AI. So AI has become an enabler in this particular situation for the company, which is also driving the profitability and the outcome for the clients. So from that perspective, I believe that I think this company looks a little bit more promising than what in the previous quarter they produced results as. So we like this particular proposition.
Got it. All right, Devin, stay with us. We also caught up with Apollo Hospitals MD, Ms. Sunita Reddy, as she shares the factors which led to the margin contraction in Q4. She also shares about the major strategic move on fertility business and says will be an investor in the fertility business. Let's listen in to those comments coming in.
I think the losses from 4 of the hospitals contributed to a contraction of 100 basis points. This will normalize, but I have to say that, our established units were at 25.6% EBITDA margin. And because of the new hospitals, we saw this coming down to 23.8%. But going forward, we will continue to open new hospitals. So I think in terms of guidance, we should look at revenue growth. Transaction first, we are the only strategic investor with the 9.9% holding. We also get 750 crores of cash in hand. Clearly, the numbers, the revenue, the performance of Apollo Healthcare is looking very good.
All right, Devin, what about Apollo Hospitals? You heard Ms. Reddy, what she had to say?
I believe that I think the online pharmacy has possibly, shown relatively better numbers. If I number reading is correct, I think against last year's 36 crore, I think this year it is about 150 crore plus kind of a number that they have been able to produce on EBITDA front. So obviously one could count this as a turnaround. Plus selling the fertility business out, I think, to the Cloud9 does make sense because I think in a vertical in which you are not specialized and the vertical which basically I think demands higher amount of thrust, I think your specialty segment in the hospital. I believe that I think they are focusing well on that aspect and getting rid of that unit I think is making more sense to me. So yes, I think corrective strategies at the same time along with the new bat coming up in the expansion. So definitely looking promising. Maybe some more details once I think the complete result is digested. I think one can probably talk about as to how the outlook should be. As of now, valuation-wise, I see it a little bit more fairly valued, but there should be a scope for further upside going forward.
Any view on Metro Brands? The management has been very consistent with their outlook. So every quarter when we speak to them, they always say that we're comfortable with the mid-teens kind of growth guidance on the top line, so 15 to 20%. On margins, they've been maintaining 30%, 29 to 31% is the broad band, and they've been largely delivering on that. Do you track it?
Not really, Rima. I think I haven't seen it.
Okay. What about BEL? Yesterday's stock fell post numbers. Street seems to like the guidance which took place in the conference call. Stock is up now, 1.5%.
It's promising. Frankly, I think we always say that if in this business, if you minus the quarter-over-quarter kind of a phenomenon, I think these kind of businesses are definitely very promising on a long-term investment perspective. Quarterly basis, I think always there is a challenge. Certain billings do not take place in one particular quarter, shifted to the next quarter. As a result of which numbers would probably look up and down in some of these situations. But overall, the management commentary appears quite promising. And we believe that I think if the market has adjusted to the valuation, probably I think it will be a good time to collect or accumulate this particular stock at lower levels.
Okay, all right. Thanks very much, Deven, for joining in and giving us a view on all of those stocks. Well, talking about some earnings, positive earnings reactions, Century Enca, just take a look at those numbers. The revenue growth is only around 9% higher, but I think that's a big surge in terms of the operating profit. And that explains why the stock is now up more than 10%. The EBITDA number, I think they've been struggling for the last few quarters. That's coming at around 55 crores, which compares with sub 10 crores. That's a big bump up. And from just a 2% margin, that's coming at around 11.5%. Now we'll have to wait by to see whether or not there is any kind of one-off. But for the time being, that's amazing move is what we're seeing on Century Enca stock spiking up as we speak. We'll look into that number in more detail. For the time being, slip into a short break. We'll be back. Shiv Diwan of Nuvama Institutional Equities will be joining in on the other side. Stay tuned. Welcome back. Well, things will get a little bit volatile as we close down the weekly contract, but the stock definitely in focus is Century Enca. As we said, there's a big turnaround into the performance, and I think the doors closed out there. The stock has gone up close to 19% post its numbers, double-digit margin, seen the street likes it. Let's welcome Shiv Diwan, the Managing Director and Head Institutional Equities of Nuvama Institutional Equities, who joins us on the show. Hi, Shiv. Good to see you in. How are you feeling about the Indian markets? Pessimism is creeping in gradually, and the naysayers are getting a little bit louder. At times, that's not a bad time to start allocating a larger proportion of money. What's your take? Headwinds ahead, but time to buy?
Yeah, good afternoon, and thanks for having me on the show. I believe that, yes, there has been some pain. Can you hear me?
Yeah.
Yeah, there definitely has been some pain that we've been going through.
Okay, All right.
Go ahead, Shiv. Go ahead.
Yeah. I think there has been some pain that we've been seeing, we've been witnessing. But having said that, like you mentioned, I think valuations now for the markets in general have become a little bit better, even whether you look at it on a market cap to GDP basis or a price to earning basis, or even the relative premium to emerging markets. So to that extent, I do believe that the time is now starting to get better in terms of getting invested. Of course, I don't think anyone will probably take a top-down view as yet. It'll have to be more stock-specific, more bottom-up, that's what we are also warranting for. There are obviously certain sectors, certain stocks that we would probably prefer and suggest and recommend to clients.
Do you want to talk to us about these ideas of yours?
Sure. So, look, the valuations for some of the sectors that I'm going to mention are probably not totally compelling. But having said that, this is a market where people will pay a premium for visibility. So I believe that some of these sectors still do have a play. One is, of course, the whole power T&D space within the whole industrial stack. Despite the fact that valuations have been a little expensive, the sector still offers very, very strong visibility, and because of the fact that there is this whole renewable connectivity that we're talking about, and the whole AI data center space that these players sort of take a part in, they should do very well. The auto pack is another space that we think after a little bit of a down move in the last quarter is starting to come back. If you've seen the numbers, they've been fairly heartening. Of course, our belief is that the best way to play the auto sector is via the auto ancillary pack. So, there are multiple stocks there that you can play with, but whether it is internal combustion engines or it is EVs, I think there is a massive opportunity in that space, and valuations now are getting far more compelling. The third sector that we also like is chemicals. They are starting to now make a comeback. I think the anti-involutionary measures that China has taken has helped. Plus, there is a currency tailwind, and there is a little bit of a volume growth that we're now starting to see in some of the chemistries. So I think these are the three sectors that will definitely benefit. And then, of course, there is one sector that most people tend to discount at this point, and that's the IT sector. Our feeling is that most of the pain has been borne by the sector. Valuations now have become very, very compelling there, and I think that there is always going to be an opportunity for some of these domestic players to be system integrators for enterprises and help in the overall process, and that's where I think some of our companies in India should do very well. Having said that, it's not going to be a play for the entire sector, and you'll have to be picky in terms of which few stocks you take from that sector.
Not private sector banks. Shiv, most of the people that we speak to on the channel seem to suggest that private sector banks valuations are something we've never seen before, at least not in the last many, many years. Valuations here, you would say, are compelling.
I agree. I think valuations are definitely compelling. I think this is a sector that people have always liked, because of the fact that you had balance sheets which are in their best possible shape over the last few years, not just this year. It's actually been over the last 2-3 years where you've seen great balance sheets. But of course, I think with private banks, the one other aspect also to look out for is that you will need, because of the large market caps, you will also need foreign institutional participation to sort of come through, because most of the domestic institutional investors are typically heavily owned on these private banks.
Got it. Okay. All right. Shiv, what about these new age themes? There was so much of excitement about them, and some of them have just fallen by the wayside. For the time being, there's not too much excitement out there. And at times, in an environment when yields move up, discounting as well, is done at a higher rate, which obviously hurts some of these new age companies. What's your view?
So I think the one thing to keep an eye on is that yes, while these new age companies have done well in the past, for now our sense is that there is a little bit of pain there in terms of visibility. We've not seen that kind of visibility that we see in maybe some of the hard asset owners, or and that's a space that I think will probably trump over the new age players at the moment. I think if you talk to investors, clients, I mean, they will tell you that today in India, what is starting to look far more interesting is the asset owners. So whether it's ports, airports, cement, utilities, these are some of the spaces that people would like to look at. We ourselves are far more constructive on that space currently, rather than the new age plays. I think that time will come, but maybe a few quarters out.
Shiv, I know in the last 1.5, now nearly 2 years, at the index level, we haven't done too much, but there have been so many opportunities to make money. So I guess that continues, and you've highlighted some of the themes that you like. But at an index level, because many people just invest via the SIP in a nifty ETF equivalent, what should they expect? What is your own assessment for the next 6 to 12 months? Do you see the markets giving returns?
Tough call there, but I would say that look, valuations are definitely compelling. There will be some stocks, and some sectors within the Nifty 50 or the Sensex 30, whatever you look at, which will sort of deliver for the sort of index. But there are also others which will probably play laggard. So to my mind, over the next 2 to 3 quarters, I think there could be some sort of sideways movement. But I believe that now the likelihood of positive bias is more so than a negative one. And of course, if the geopolitical situation improves, then you could probably see a little bit of an impetus, starting up and then sort of plateauing out.
Shiv, what about this Indian rupee fall? It's definitely hurting sentiment, but people are trying to find winners. What is your view first with regard to the rupee? If we see some stability, if we see a couple of measures that help the rupee, how positive would it be? Point number one. Point number two is, have you managed to find any winners? You already told us about tech, and we'll see how that one plays out. But any other sectors that could be better placed because of the depreciation we've seen on the rupee?
So first of all, yes, I think rupee has the rupee depreciation has definitely hurt the raw material part of most companies. And obviously, if that were to correct itself, then that things could get much better for some of these sectors, whether it's consumer or pharma or or even maybe chemicals. Now, on the other hand, like I mentioned earlier, that chemicals, the exporters within the chemicals pack should definitely be beneficiaries. I think certain pharmaceutical names could also sort of benefit if the rupee were to start improving. And this pain has also resulted in the fact, for most foreign institutional investors, just by virtue of holding on to their current investments, that's hurt them a little bit, right? Because of the rupee fall. And if the rupee fall, it does get arrested and things start to get better, I suspect that you should start to see some of them starting to come back. And that overall should help sentiment as well. So I think there is an overarching theme as well that could play out if with rupee fall were to get arrested.
How are you hedging yourself, Shiv, if this war lingers on longer? It's been 12 weeks already. There's still no resolution in sight. We've had multiple false starts where our hopes have been raised only to be dashed one day later with a post on Truth Social. So if this war lingers on, how are you hedging this portfolio?
The one sector that we didn't speak about, and which is obviously a sector that has been a bellwether for a lot of the domestic funds and for a lot of the players here, has been FMCG. I think you've always seen volume growth that has been heartening, but for the first time out, now we are starting to see a little bit of pricing growth coming back, and that should definitely benefit the sector, and also given the fact that it is one of those sectors which is not too volatile, which will continue to see consumption growth slow and steady at a pace that we like. So that's one sector that we definitely want to be in, and the domestic consumption story, whether it is auto lines like I mentioned, or even the cement plays, which will sort of start to come back, are the sectors that we think we would like. Obviously, I won't mention individual stocks, but these are the sectors that we think someone could stay invested in. And if we get a solution to the war, then of course then there is a broader base to play on.
Got it. Okay. All right. Thanks, Shiv. Wishing you a good remainder of the day, and we catch up soon. Thanks for giving us some of your thoughts on the markets as well as individual sectors. By the way, let's do a quick check on the F&O market, then the advanced decline ratio first. That's heartening to see. For many trading sessions now, for most of the last few at least, the number of stocks advancing outweighing the number of stocks declining. So you wouldn't mind the headline index actually being in a bit of a range, provided that continues to move up. The other positive is the India VIX as well. In a market that's more or less flattish, the VIX is cooling off. That's telling you the street is factoring in better times ahead, at least as of now. The VIX a few sessions ago went to around 19.5 odd. Now it's sub that 18 mark. You like it. The options data should come up for you. 23,800 call. The premium out there has come down to around 107. 23,700 call. The premium out there has come down to around 70. Remember, these are strikes where you've got the direction right, because the Nifty is up, right, 20, 30 points or thereabouts. But you're not making any money because the writers are at play here. And they believe this band between the 50 and the 20-day MA, which incidentally is around this 23,800 to around 24,000 mark, they believe that mark is going to get defended. So that's why with the markets up or more or less flattish as well, you're not making money on the out-of-the-money calls out there. Well, moving to the individual stocks, MCX, that one's seen a one-way run. After a while, I'm seeing such large shots on that particular one. So there are shots that are getting added on MCX. There's some rolls as well that are taking place because you'll have the monthly expiry that will take place on the coming Tuesday itself. You have HDFC AMC. That one's come in for some fresh buying actually in today's trading session. So some delivery-based buying backed by some fresh buying out there. And GAIL, a stock that's underperformed. Remember, it's corrected very swiftly from around the 200 mark to sub 160 rupees. That one, in fact, has come in for a bit of a short covering bounce in today's trading session. Net, we seem to be in a bit of a range. Downside, 23,250. Upside, 23,800 appears to be quite a stiff resistance. Take a short break, come back. Nimesh is waiting for us on the other side. He'll tell you what to expect in D-Street Chatter. And then our technical experts as well will be joining in. You don't want to miss this. Welcome back. Markets as flat as can be, but we're not short of action. So good time to go across to D-Street Chatter where Nimesh joins us to tell us What is he picking up in terms of flows and the mood out there? Nimesh, good afternoon.
Hi, afternoon, Nigel. Another day of consolidation. It's been a very narrow range for the last couple of days. But within that, there are a lot of action in the broader market names as well. So that momentum has picked up again in the broader market stocks. Selective, buying and outperformance has started. And of course, large part of that outperformance is backed by earnings. So where there is a strong earning, you're seeing a very strong reactions to the broader market stocks as well. Case in point, being like something like a protein is up. Good 20% upper circuit in today's market. From a flow perspective, again, a mixed day of trade. At least the selling intensity is much lower now, and that's the case today as well. But within that, I guess there's a bit of selling pressure today in the financial names. So some select private banks, PSU names, as well as the NBFCs is where there's a bit of supply from the large institutions. Again, technically, we seems to be in a very narrow range for the last couple of weeks now. 23,200, 300 on the downside. And 23,900 upside is a bit of a resistance, so we'll be in that range for the time being. Looks like any development on the war front or any announcement by the Indian government over the weekend will be an important trigger to watch out for. But broadly, it's been a range-bound day of trade and a bit of selling in the financial names.
Ooh, something over the weekend that'll be great, Nimesh. But we'll cover it on Monday. Just assure that. Tell us individual stocks, Nimesh. What are you picking up?
So the first item on the list is Raymond Limited. Among the three demerged businesses, the business which is into defense and aerospace. The board has actually announced that they're going to be a fundraising plan. My sense is large part of this fundraising will be done for inorganic moves. Potential couple of acquisitions is something which Raymond may do in the weeks to come. So that's a trigger as far as Raymond Limited is concerned. The second name is Grasim. Big move on that name, up 600% on large volumes. There is buying from larger FIs in today's market post the call. And also there is a Morgan Stanley tactical buy which has led to this up move in Grasim today. The third is HFCL. We've seen one part of the big rally in stocks like HFCL and Stellite Tech in the last few months. But now there is a strong buzz that maybe in HFCL you'll hear a very large order win for the company very soon. So that's the trigger as far as HFCL is concerned. And last couple of names where there is selling pressure today and which is very high. Swiggy as well as Canara Bank. So expect very high delivery volumes, but on the sell side in both those names from larger FIs today.
Got it. Okay, all right, Nimesh. Thanks a lot for giving us all those stocks and the setup as well in terms of the markets. Mitesh Thakkar is back with us. Mitesh, want to fill us in with some fresh calls?
So on the BTSC side, Nigel, Sammaan Capital has had a good day. That's a BTSC with a stop below 150, 1/2 for targets of 157. And Motherson, I think that's on the stock. BTSC here with a stop at 135.5 for targets of 140.
Beautiful. Thanks a lot for joining in and giving us that, Mitesh. Well, let's focus on the stock of the day from the Nifty pack itself. Grasim, they came out with a set of numbers. And as we always tell you, most of the value of the stock comes in from their holding in UltraTech Cement and bulk of their profitability as well. But the standalone numbers, which is a smaller part of their business, looked quite good. The EBITDA number came in at around 540 crores. Remember, the street was bracing for a number of around 460 crores. So good beat out there. Margins as well, 30 basis points on a low base, looked quite good in comparison to what we were working with. Now, the segmental breakup should come up for you on the screen, and we'll compare the segmental EBITDA with what Kotak had thrown up. So in terms of their staple fibers business, the VSF business, it came at around 590 crores. Kotak's estimate was 550 crores. Chemicals business, on a low base, that came at around 300 crores. Kotak's estimate was around 280 crores. And the paints business actually did quite well. And that business is gradually scaling up. So the revenue growth was more than 50%. The volume growth on a sequential basis was close to around 17%. And they've gone ahead and they've pulled up some market share as well by close to around 90 basis points. So paints, no worries on that front. But we look at the new businesses and the losses out there are a little bit lower. What's in the new businesses? The B2B e-commerce business and the paints business. So the losses a few quarters ago were upward closer to around 315 to around 320 crores. Now the losses are coming down. So that's good because the operational efficiency seems to be playing out. And also the company is saying that part of that new business, which is the B2B e-commerce business, that will be profitable by the end of this fiscal year itself. So thumbs up out there. Capital allocation is always something the street looks at very closely with regard to Grasim. They will earn a dividend of close to 3,970 crores dividend pre-tax from UltraTech Cement because they have doled out that big dividend. Grasim, out of the 3,900 crores odd, they'll be investing 2,900 crores in Aditya Birla Capital. Yes, it's a company that they already hold some stake in, but what the street was waiting for is some clarity with regard to entering a new business. The management indicated no new business entry is planned at this point of time. They're looking at stabilizing the current businesses. And brokerages, they're quite impressed. Novama has gone ahead. They've upgraded the stock to buy from hold. They've revised the target price as well. They say that the improving operating performance and sustained market share gains in paints is what they like. Jefferies as well, they have upped their target price on that one. They're saying that the improved standalone business will lead to some lower holding company discount. Currently, it's at around 38%. And Motilal Oswal as well, maintaining their buy rating, 3,440 rupees. Put everything together, the street likes it. The stock spurting up close to around 6%. Sudeep Bandyopadhyay joins us on the show. Sudeep, Grasim, we've seen this before. It goes to around 3,400, 3,500, and then it pulls back a little bit. What do you make of the numbers? What do you make of the commentary? And what would you do at 3,100 rupees?
Good afternoon, Nigel. I think, pretty good set of numbers. In fact, honestly, I was not expecting the other businesses to, turn out the kind of numbers they came up with. Kotak's estimate, they did beat. And in fact, whatever internal estimates we were making, the businesses came out with much better set of numbers. So obviously, I think it's quite impressive. Also, what is impressive is market share gain in the paints business and the losses in the new businesses coming down marginally, but still coming down in spite of the fact that they're aggressively pushing in the market and gaining market share. So on the whole, I think it's a pretty good set of numbers, and the management commentary on capital deployment in AB Capital also is pretty reassuring as opposed to entering some of the new segment or business. So overall, we do like Grasim. We have been, kind of favoring buying into Grasim. Though there is a holding company discount, we still believe that it's a good time to buy into Grasim even now.
Sudeep, hi, afternoon. Great to have you on the show today. Let's talk about Jubilant FoodWorks. But before I come across to you to get your views, let me go across to Mangalam to tell us what the street didn't like in the quarter gone by.
Well, there were a couple of things that the street perhaps didn't like, despite, there being an EBITDA beat against consensus in the fourth quarter. It was the lack of revenue growth that came by. That's exactly why, the street was caught unawares. But it's surprising also because the company had given their fourth quarter update already. It was a 0.2% like-for-like growth that came in for Domino's India. Margins at 20.5%. Net profit lower, but that was largely because of higher depreciation. So that was a non-cash expense. Maybe the street expected better commentary coming ahead, but management has guided for 5 to 7% like-for-like growth, which was pretty similar to what the company had done on a 2-year CAGR, even in the fourth quarter, where a 0.2% like-for-like growth actually, followed a 12% growth in the base quarter. Add to that, they maintained that, going forward, the first quarter, the quarter that we're currently in, will have better like-for-like growth as well as compared to the fourth quarter. So there is sequential improvement. However, in the very near term, margins could be a bit of a problem, and that's largely because of higher fuel and freight costs and higher wages as well. So maybe the street is taking, note of the fact that maybe revenues aren't growing as fast. And the one thing that was good in the numbers, which was an EBITDA beat, will not sustain in the first quarter because the inflation is high for a lot of their key inputs, which include fuel and wages. So which is why the stock has seen a bit of a sell-off. And add to all of this, trading at around 75, 80 times valuations, never in favor of Jubilant FoodWorks.
Thank you very much for that. Mangalam, also ITC comes out with numbers later today, and you said volume growth this quarter will be impacted on account of the tax changes.
Yes, volume growth this quarter will be impacted on account of the tax changes. So the street is not working with much this time around for ITC. But mind you, good performance came in from Godfrey Phillips and VST Industries as well. So can ITC surprise this time around or not? The stock is already down 25% in 2026 so far, trading at around 18.5 times FY27 price to earnings. Most analysts on the street believe that maybe the stock has priced a lot of the negatives in. The street is working with 3 to 4% growth in the cigarette volume this time around. FMCG business is likely to do well for them, 10 to 12%, with a margin improvement of 120 to 140 basis points as well. Paper continues to struggle because of imports of raw, cheap paper from other countries. So that business likely to grow anywhere between 3 to 5% as well. Put all of this together, you're looking at a revenue growth of around 3.5%. You're also looking at an EBITDA growth to the tune of around 4 or 5%, and the net profit grows a similar amount. Impact on account of higher prices in the cigarette business is something that we will monitor. 3 to 4% volume growth and a much higher 25 to 30% sort of price hike that the company is taken in the months on a gradual basis with effect from February 1 is something that, the impact of that on volumes going forward is something that we will monitor very closely. But for these numbers, not much is expected.
Got it. Okay, all right. Thanks a lot, Mangalam, for that. Well, let's go across to Sudeep Bandyopadhyay. Sudeep, you have a view on either of the stocks that Mangalam discussed? I would be hoping that he actually gave us a pizza today. That didn't happen, but not wrong in hoping. Anyway, tell us what's your view.
Well, as far as Domino's is concerned, I think Jubilant FoodWorks rather. I think the valuation has always been something which I find very difficult to reconcile with the the on-ground performance, and particularly so now when I think there are a lot of pressures coming on the margin because of input cost, multiple input cost inflation. So the growth also has slowed down. It's not that it's a scorching growth. So, from a valuation perspective, I think I will be careful. I don't think I will recommend a buy or entry into Jubilant Foods at this juncture. As far as ITC is concerned, I think, the fourth quarter, which they will be announcing now, will be okay, 3-4% growth. And as Mangalam was mentioning, but what will be interesting is how they navigate the coming current fiscal. And the first quarter and second quarter of the current fiscal will be extremely interesting for the tobacco companies. The tobacco, we all know the taxes have gone up significantly. Some price hikes have been taken, but some part of the hike hasn't been passed on to the customers. So there will be compression on the margins for pretty much all the companies, including ITC, in some manner. So, the way forward looks extremely challenging. Also, the competition from Marlboro and the GPI is intensifying. So, considering everything, I think 27 will be a very, very challenging and interesting year for ITC.
Challenging or interesting, Sudeep?
Both. Challenging and interesting. I deliberately used both the words because, we'll have to see how they navigate this turbulence. And because of this, I think it will become interesting.
Okay, we'll come back to you. Let's talk about Sammaan Capital. Clearly one of the stocks of the day, trading with steady gains following the Q4 numbers. Massive balance sheet cleanup led to the impact on asset quality that is down to nearly zero. So earlier today, we had a chat with the MD and CEO, Gagan Banga, to understand the way forward. Listen in to excerpts of our chat.
Firmly and finally able to say that the legacy book is closed. And that is the first message I would like to give you, that the legacy book is finally, formally, firmly closed. Fiscal 27, the most important thing to watch out is how the ratings, which in the first 50 days of IHC's investments have already been upgraded to AA+, continue to move up in the trajectory which is desired, which is the highest possible ratings. On top of that, we intend to disburse a little over 30,000 crores, and that should take the book by end of next year. So this year, we should end with an AUM of over 70,000 crores. Next year, with an AUM of over 1 lakh crore. The cost of capital should come down by 120 basis points to where it is today on the entire stock. On flow, it should come down 160 basis points, and this should add up to profits of around 1,400 crores or a little above 1,400 crores this year.
Okay, that's the guidance shared. Sudeep, any view on Sammaan Capital?
I think it's a fresh lease of life for the company. The kind of capital they have got should definitely help them rebuild the business. And I think the past, I think that's what the statement being put out by the management, that they are very clearly drawing a line, and the past is now very well behind them. They are looking at moving ahead at a very, very rapid pace. Capital is not a constraint. Parentage now is absolutely clear and quite credible. So I'm positive on Sammaan Capital. I think whatever has happened has happened. Now we should look at this company fresh, and if that is the case, then it makes sense to buy, considering the fact that it is quoting at a valuation which is much more attractive compared to many of its peers.
Stay on, Sudeep. Need to slip into a very short break. We'll come back with more on the market. Stay tuned. Okay, just winding down. We've got about 7 minutes to go before we wrap up trade. Markets have come off from the day's high by about 200 points, ending around the 23,650. ITC number, sorry, I missed that. Net profit is coming at 5,113 crore. This is a good more than 100 crore ahead of the CNBC-TV18 poll. The stock is spiking up. So at least on the bottom line, there is a beat. But as Mangalam was telling us, on account of tax changes, the expectations for a volume growth are fairly muted, 3 to 4%. In the prior few quarters, volume growth was picking up. It was inching up towards 6-7%. But this quarter, it will be on the softer side. That said, many of the peers, like Godfrey Phillips, when they came out with their numbers, were very, very strong. One number to work with right now, and that's the bottom line number. 5,113 crore, and that has come in ahead of expectations. On the back of those tax changes and muted expectation, the stock also hasn't done too much. From the beginning of the year, the stock is down 23% so far this year. So cigarette business is expected to be a bit subdued, but FMCG business could do well. I think the street is working with about a 10-11% revenue growth in FMCG, assisted with margin improvement. And nowadays, many of the experts on the channel seem to be suggesting that FMCG is actually a good play on rising inflation because they are able to pass on costs. And ITC has an FMCG business. One number only, stock is on the flatter side. It went up, now it's cooling off. Okay, revenue has come in much, much lower than expectations. 16,000 crore is the revenue versus expectation of 18,000 crore rupees. So this is the revenue. We generally look at the number X of excise. So we'll just try and get that. But at least prima facie, it looks like a big miss. So that initial excitement post the profit beat is now getting cooled off, and the stock is dipping nearly 0.5% lower. So revenues have come in lower than expectations. Profits are slightly ahead. But the street is now reacting to the miss on the bottom line. Do you have any other numbers on ITC?
No, Rima, I just wait by for Mangalam actually to join us. The net profit number in line, the top line, in fact, it appears a bit of a miss, but I think Mangalam will join us to give us some clarity on that front. So we'll just wait by, he'll come in. I think Mangalam's, due to come in. The stock actually, after seeing a bit of a spurt up, it's actually cooled off. So I think first look at the numbers, the street thought that it was much better. I think they just went by the net profit number. And now, in fact, they're doing a quicker analysis and, point-to-point analysis. We'll try to get in some kind of volume growth or maybe, in fact, a margin performance as well. That'll give us further clarity on this one. Remember, it's a bit of a tricky one because some of those numbers get regrouped as well, and there are taxes involved out here. We'll get back to that set of numbers. For the time being, though, the markets itself are down close to 20 points from being up close to 150 points in today's trading session. So the markets have moved lower in the last few minutes. And we have a lot of numbers that are coming in there. You should remove that Century Enka. It's ITC is the stock that we're talking about. And the EBITDA number, if I saw that correct, it was at around 6,400 crores approximately. I think we should get that one as well up for you on the screen. Mangalam, we're waiting for you. Tell us, how are the numbers?
Well, these numbers look absolutely in line with street expectations, notwithstanding the big divergence that we're seeing on the top line. And that's largely because of the excise duty changes that have come about. So which is why the analyst expectations for that. You strip all of that off, these numbers are in line. The street was working with a number of 5,000 crores on the bottom line. The company's reported about 5,100 crores. The EBITDA, the street was working with a number closer to 6,200 crores. The company is reported around 6,400 crores. The important numbers for ITC, the most important number is the cigarette revenue growth out here. The reported cigarette revenue growth has been 31%. But that, remember, includes the excise duty related price hikes that the companies have taken as well. So between Feb and March, the price hikes would have been around to the tune of 20 to 25%. The right way to assess volumes would be, the EBIT, the way the EBIT has grown. The cigarette EBIT has grown by about 7%. And assuming that leaf tobacco prices have cooled off from last year, the EBIT would have grown a tad higher than, the margin or the volumes by and large. So this means that the cigarette volume growth has been between 4 to 5%, as against street expectations of 3 to 4%, which again is pretty much in line. A mild outperformance could be on account of pre-stocking ahead of the cigarette excise duty being hiked. If you look at the FMCG business as well, street was working with a number of anywhere between 10 to 11% in terms of revenue growth. That too has been around high single digits itself. So by and large, these numbers are absolutely in line with street expectations. The only divergence that we are seeing with the poll is because of the one-offs and all the excise duty related impacts that have happened. And that explains why the stock is going into close with absolutely flat moves.
Got it, Mangalam. Thanks a lot for explaining that to us. The tax changes are the reason why, in fact, we are seeing a bit of a miss, on the top line itself. Otherwise, bang in line, as Mangalam said. By the way, pull up a couple of stocks. Ganesha Ecosphere, that stock has spiked up to the high point of the day. Big move is what we're seeing out there. Massive move on that name. I think it comes out with a set of numbers later today. So Ganesha Ecosphere comes up for you. Jai Bharat, the stock that's been running, that's seen an additional uptake now in the last few minutes. I think we should pull up both these two names, both of them moving higher as we speak. And Misho, actually, the stock was in the green. That's suddenly fallen off the cliff. That's moved to the low point of the day. And Finiotex Chemicals, another stock, that's been moving up one way. That's coming for a sharp downtake. Very, very wild moves, 25 to 35 rupees, 35 rupees to around 31 rupees. So last few minutes down. But time to wind down the markets then, and we'll thank Sudeep on that note for joining in and giving us his view on a lot of the stocks that we did discuss. For the Nifty, the big gainer today was Grasim. Good numbers on the standalone basis. Commentary was positive. The street latched onto it, and brokerage is quite positive. Interglobe Aviation up 3%, and Apollo Hospitals as well, sounding positive on the way ahead. So all the stocks did pretty well. Bajaj Finserv Finance, that stock was down 1.5%, and HUL as well was a little under the weather. The tech pack, well, it's had a good run. Today it ran into some resistance. As we pointed out earlier today, it had conquered the 20 DMA, but it ran into resistance at the 50 DMA, and it got rejected out there. The sector of the day actually was EMS, because Amber was up, you had Keynes that was up, and Dixon Technology as well that did pretty well in today's trading session. Stocks making fresh 52-week high. Angel one is top of the list. A stock that went to 210 rupees in March. In May, it's at around 340 rupees. So big mover out there is what we saw on that name as well. But there were some large losers as well. Jubilant Foodworks, the growth is not as much as what the street anticipated. The EBITDA number was a beat, but the street is cautious whether or not they can sustain these numbers. Also, valuation-wise, not very, very cheap. PI Industries was down 5%, and Bosch as well ended with a cut of around 4.5% in today's trading session. A couple of names that did very, very well from the cash market stocks. From the broader markets, you had Jai Bharat that was up. Triveni Turbine actually has bounced up in style. JSW Cement as well did pretty well. That was up close to around 4.5%. And Lenskart, who's saying it's expensive? The stock is up 2.5% after seeing such a big rally in trade today. Ola, under the weather, this stock ended down with a cut of around 4%. Last quarter's numbers were a washout. They're promising for better times, but the street for the time being is not buying into it. Stock goes home with a cut of around 4%. Well, we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next.